Good afternoon, everyone. As you pointed out, my name's Greg Talbot. I work at AAR with Shane in the London office, and I'm the Business Development Manager there. The title of this talk is Comparing the Protection Offered by Different Insurance Pools Worldwide, and I'm also acutely aware that I'm the barrier between you starting the Romanian evening, so I'll try and keep to schedule.
No, definitely not. We will have a lot of questions, so just be prepared.
Okay. I'll try to keep to schedule, or if I'll go short, if anything. So if we look at the agenda, first of all, we have a rather grand title first, Insure the World. And what I'm going to touch on is some of the hot topics of the moment, filling that protection gap that we've seen a couple of sessions on already today. And then for the natural pools part, I'm going to give a brief introduction as to what these natural pools actually do, who has them, and why they have them. And I go into a bit more detail of the TCIP, PITT, Romania, TTIP of Taiwan, and also the EQC of New Zealand. And the analysis, it sounds quite dull, but it potentially could be the most interesting part of the talk. So, Insure the World. So what we have on this particular graphic are all the regions of the world that AAR currently model, all the green areas we can see. So as you might imagine, we cover all of the regions around the Pacific Ring of Fire, on the Eastern Pacific, and then also on the Western Pacific. In Europe, we have European windstorm models, we have European earthquake models, as my colleague alluded to earlier, and we also have model flood in some of the regions of Europe. But the cat modeling industry really got off to a start after Hurricane Andrew, and the US is probably where we have most of our popular models. We have US hurricane, US earthquake, we have wildfire, straight line wind models, tornado, hail, winter storm, and we even have some man-made perils such as terrorism, and increasingly we're looking to move into areas like terrorism as well. So let me start by explaining what this insured AAL actually means. AAL stands for Average Annual Loss. And to obtain an average annual loss of 74 billion, what we have done is run all of our global models through our industry exposure database, run it for 10,000 simulated years of loss, and divided it by the number of years. And that's the very definition of expected loss. So as we can see here, we've got an insured AAL of 74 billion, yet an economic AAL of 307 billion. So the economic AAL also takes into account the uninsured losses and some of those sort of bespoke things that Shane mentioned, like contingent business interruption or uninsurable risks. So we can see a gap there worldwide of $233 billion. But as well as just looking at the average annual loss, we have metrics on different return periods. But let me just explain what a return period actually is. So for the 250-year return period, what that actually equates to is a 0.4% probability of losses either equaling or exceeding that 305 billion USD mark. And consequently, for the 1,000-year return period, that is a probability of 0.1% of it equaling or exceeding 400 billion. But what this slide also shows us is that there are three prominent brokers with slightly different definitions of reinsurance capital or capacity in the world. Now, what you will notice, though, is that they all exceed or are equal to that 1,000-year return period loss. So clearly, there is enough cover in the world to do more than what we are currently doing in some of these territories. Now, this is an interesting slide, and you have to think of it slightly hypothetically. How much would it cost to actually insure the world? So if we take the assumption that everyone were actually insured, and we had a stretch of reinsurance protection of 1% of GDP going up to 1.5% of GDP, that stretch of reinsurance, we could potentially expect a premium of around $8 billion. And what we would probably see is that it would attach at the 1.62% mark and potentially exhaust somewhere around 0.43%. So the next part is there expectation that the government will fill the gap? Now, I recently went to another country in Europe that's prone to earthquakes, and the very much reaction that I got were that earthquakes are a natural act of God. And therefore, they were quite blasé about actually buying insurance. They thought they'll just let the natural cause of events take place. So another way to look at that is they're not actually buying insurance. Or a slightly more cynical view would be that the government's going to fill the gap. So if we look at one of the most developed nations in the world, the US, and we look here at this pattern of losses paid by taxpayers, going back to 1955 and Hurricane Diane, it's estimated that only about 6% of those total losses were covered by taxpayers. Ever since, that percentage has increased. And now we can see with Hurricane Sandy, it's estimated that something like 80% of the overall losses were paid by taxpayers.
But that includes insured loss.
So let's now look our attention onto natural catastrophe pools themselves. And what's in a name? I'll probably use these names interchangeably, whether they're pools, whether they're schemes, natural catastrophe, insurance, reinsurance pool schemes. But in terms of their goal, it's universal. And that's to guarantee affordable and stable insurance premiums to a broader mass of people. And that will be the goal of the PITT, TRIPE, TCIP, and EQC at the same time. And to provide an immediate post-disaster financing proportionate to the actual incurred loss. So we'll see that sometimes with the EQC, post the Christchurch losses, that they've managed to complete about 98% of those claims, which you could argue is quite a long process. But what you can see is that some great synergies between these natural catastrophe pools and filling that protection gap. And what's interesting as well is that the cost to actually do this, set up insurance and have all the claims, is going to be much less than post-disaster. And this is something that I spoke to one of the charities, Red R, who go and visit countries post-disaster. And he said the amount of bureaucracy that's involved and political sort of freezes on actually what's happening is incredible. So you'd be much better off having insurance in the first place. So what's the problem? I mean, every country in the world is in some way exposed to natural catastrophes, whether it's earthquakes, typhoons, hurricanes, floods. If it's not floods, then it's probably drought. But some countries are more prone than others. So if we took the example of a small Pacific island state, they're going to have a limited size and borrowing capacity. You know, the chances of them being able to bounce back quickly compared to a developed nation is going to be cripplingly small. There's a heavy dependence on post-disaster financing and aid from international donors. It was only last week I was speaking to someone from the World Bank, and he said it was just so embarrassing post-disaster how there'll be an image of an African child with flies swarming around his head asking for money. I mean, there are so many more advanced mechanisms available out there that we shouldn't be in that position centuries later. Access to insurance is limited due to the size of the placement and transaction costs. That's why something like a compulsory scheme will make the economies of scale greater. And then in some of these states also there's a lack of historical information on natural disasters. I mean, we're quite blessed in the UK in that we seem to be obsessed with weather records. And I think that's probably somewhat true in Europe. But for some small states in the Pacific or Indian Ocean, they just don't have the historical claims information to even begin to model some of these things properly. So let's look at the concept of risk pooling. So on the left-hand side, we have an example where there is no risk pool, and then on the right-hand side, an example where there is a risk pool. And as you can probably imagine, the very presence of having a risk pool will not either increase or decrease the frequency or severity of an event. However, it will reduce the operating costs because there will be significant economies of scale of issuing similar products across the whole nation. But moreover, there will be a reduction of cost of capital. So there'll be the expectation that your reinsurance costs will be much lower because you've got a much more diversified portfolio of risks. And in addition to that, you'll be able to probably retain more events in your deductible cover. So let's have a look at the value proposition here. We've just seen on the previous slide that there's some serious advantages to having these pools and there being a better spread of risk and more efficient use of capital. These pools create and spread the risk, and the important thing here is the critical mass. I've been talking to insurers, and what they've been telling me is the reason often they don't enter some of these developing markets is that there isn't a critical mass of policies to keep on going. And also the renewals are also very important as well. So a question for you guys really is, would making an insurance compulsory and avoid anti-selection and overcome some of this lack of risk awareness? I mean, we have an example in the UK with Flood Re, where before the advent of Flood Re, some insurers were able to just reject taking some houses on risk because they were on a floodplain. As somebody mentioned earlier, there's a propensity to live near the sea or a river, and they could just decline to insure it. So with the advent of Flood Re, now they can accept the risk, but cede it off to Flood Re. So there's this sort of approach that everyone is actually now insurable. And it also provides a more efficient platform to transfer catastrophic risk. I mean, it was mentioned earlier that I used to work at some Lloyd's syndicates, and I would help write some of these policies, the PITT, the TCIP, the TRIPE, and the EQC. And it just goes to show you, you perhaps don't appreciate that all of these policies will have worldwide reinsurance, even in the Lloyd's market. It's also going to provide a mechanism to encourage risk mitigation and safer construction practices. It's often a lot cheaper to have these mitigation practices before an event rather than having to pay afterwards, because you're most likely going to be out of pocket if you do so. And as we'll see later, all of these insurance pools will increase risk awareness. I mean, I thought it was quite a good idea to have some of those sort of adverts on your mobile apps, etc., and just sort of increase the knowledge there. It will also build up some of the catastrophe reserves. I know some of these pools are for profit and some of them aren't for profit, but building up those catastrophe reserves will certainly make countries more resilient when it's time to pay out the losses. And also it's going to facilitate the research and investment and modelling of catastrophe risk. So what I've got here now is some recent press coverage that I have seen just in the last 4 weeks or so. And the first article is one from AM Best, and that's suggesting that more NAT CAT schemes are needed in Europe. And the particular attention here was Germany, Italy, and the Netherlands, and they're suggesting they should copy examples of these schemes, such as the Consortio in Spain, the CCR in France, or even our own Flood Re in the UK. The next one is an article from the Business Mirror, and this is actually regarding the Philippines. Philippines, as you well know, is very well exposed to natural catastrophes, and there's an executive order that they are trying to put across a compulsory scheme for natural catastrophe insurance. Now, the problem seems to be that not everyone wants it to be compulsory, but as we shall see with the 4 pools later, there seems to be a different spectrum of what actually compulsory means. One interesting thing as well about the Philippines is that Manila and the metropolitan Manila region in the Philippines, according to the Lloyd's Risk Index, is the 4th most risky city in the world in terms of uninsured losses and the propensity to be affected by some of these natural catastrophes. This is just a little quote from Ban Ki-moon. He's suggesting that we should do much more on climate catastrophes. And what I would like to do is extend some of the use of these pools to also include the effect of climate change. And finally, I haven't really touched upon ILS at all on this presentation as yet. And that's just to say that the reinsurance and ILS world seem to be converging a lot of last few years. And the ILS regions can also play a massive role in this. So if I'll give you an example. I don't know if anyone's heard of the multi-cat bond in Mexico. It doesn't look like it, but it's a cat bond that has a parametric trigger. And what I mean by that, if there's certain earthquakes of a certain magnitude in the Mexico City region, then it could potentially pay out if there's a sufficient magnitude. And they have a differing trigger in different parts of the country. Now, as said, it was a multi-cat, and it also has a function for hurricanes also. And if you remember in 2014, with Hurricane Odile hitting the Baja Peninsula, it was a very intense storm. But even so, the central pressure as it hit landfall was not enough for this cat bond to pay out. However, last year with Hurricane Patricia, the central pressure here was enough. And even though the storm was not as damaging, it was probably about a third of the overall losses of Hurricane Odile, it ended up paying out. And the Mexican government got paid $50 million from the investors on that cat bond. So countries with active NatCat schemes. This is in no way exhaustive. I've certainly learnt today that Azerbaijan and Iran should be coloured blue here in this example. But can anyone tell me in the United States which they think is probably the most seismic state of the country? Most seismically active, most earthquakes. Well, that's the trick question. I mean, most people would probably think that it was California, and we do have a pool there, the California Earthquake Authority, but currently it's probably actually Oklahoma, due to the fracking and drilling in Oklahoma. So they're actually thinking of having a NatCat scheme in Oklahoma too. But there are other ones in the US. There's the wind pools in Texas, and also the FHCF, the Florida Hurricane Catastrophe Fund there too. We also have ARC in Africa, the Africa Risk Capacity. We also have some in the Pacific region. And here, Mongolia is covered because it has an agricultural pool, and I already mentioned some of the ones in Europe. But for the focus of the talk today, we're going to really be talking about EQC, PITT, TCIP, and TRIPE. So EQC, this was set up in 1945 after the Wairarapa earthquake in 1944. I apologize for all my pronunciations herein, but the Earthquake Act had 4 main roles, and that was 1, to manage the National Disaster Fund. It was to educate, conduct research, and also settle claims. So they're very similar goals to what we saw earlier in the presentation. But the interesting thing here is that they automatically get cover if they have home and contents cover. And the EQC is a first loss policy. Therefore, it will pay the first 100,000 New Zealand dollars, which equates to about 60,000 euros for home, and another 20,000 New Zealand, which is about 12,000 euros for contents or damage to land. Above and beyond that, it will be down to a private insurer. I'm not going to pronounce that. So the TCIP now of Turkey, it seems to be the motto of earthquake will pass and life will go on. There's a certain amount of inevitability about when the next earthquake will be, rather than if. This was founded after the 1999 Marmara earthquake. Learnt today it shouldn't be Izmit. But in 1999, there was only a penetration of about 2% outside of Istanbul. We heard earlier today that the average is around about 40%, but it is higher in some areas near Istanbul. This particular picture is from 2011 and suggests that the penetration rate near Istanbul was nearly up to 60% in some areas. Here we have a maximum sum insured of 150,000 Turkish lira, which is about 45,000 euros. I've all got these in a table at the end, so you don't need to memorize them. But commercial and industrial will require private insurance. So again, it was mainly for residential. This is one of the differentiating parts of the TCIP in that it is tariff-based. So I had a little go at this myself. And I pretended I was in Besiktas, and I entered some construction types, some dates of construction, and the size of my apartment. And what it was able to generate for me was a premium and overall insurance amount. One really good thing about it, I also thought, was that there's a renewal discount. So if you renew in your first year, you get a 10% discount, and therein it's 20% thereafter. So what I mentioned about sort of a critical mass of people, I think this will help some of those problems. On to PITT. This was established in 2009, a joint effort of 12 companies. And unlike some of the other ones, it also includes flood. The goals are similar to what we have already seen in producing a simple product, accessible to all the homeowners, and also the prompt payment of losses as well. In terms of premium, it's kind of fixed. It's a €20 premium if you have a wood, concrete or brick house, €10 premium if you have a house made of adobe. We discussed earlier this morning how potentially that should actually be the other way around to sort of encourage stronger building practices. Slight difference between PITT is that this was established pre-event, so unlike Turkey with the Marmara earthquake and the EQC with the event in 1944, there hasn't been a recent event sort of in 2008, etc. How it works with other risks and with greater limits, you can see in the bottom left there the PAD policies covering the earthquake, landslide and flood. But for other risks, this is not applicable, and therefore you would need a facultative policy. In terms of some of the total policies in force, which I've kindly taken from the website, it looks like we're up to sort of a 1.7 million at the moment. There looks to be a dip kind of around from November 11, which I attributed to people not necessarily renewing. And this is potentially what I was talking about with people not necessarily understanding that it was compulsory. And then the TTIP from Taiwan. This was established following a large earthquake in Chi-Chi, 1999. And that had an economic loss of 12 billion and probably has the fewest number of residents that were insured, just 1%. It was designed like the others to diversify risk. And unlike the others, though, instead of sort of being a first loss one, there's a group of local co-insurers that will take the first hit. And new fire policies issued on an annual basis will automatically cover earthquake. In terms of the limits, we're looking at about US dollars, about 37,000 for buildings and 5.5 for living expenses. But interestingly, here, it has to be a total loss or a constructive total loss. So the damage to the house has to be above 50%. The take-up rate of this policy is only about 30%. So I'm going to do a slight comparison of the 4 countries, and this is really key to understanding some of the figures in my analysis section. So with New Zealand, we've got a population of 4.6 million. That is believe it or not, a nightlight. It's from NASA as well, and it just goes to show you how sparsely populated it is. You can see some of the key cities. You can see probably Christchurch down here, Auckland up further on the North Island. Then we've seen this already in Shane's presentation. This comes from our industry exposure database and is a residential picture. Population of 19.5 million. The area is very comparable to that of the UK, of about 93,000 square miles, but has a population of around about a third. Taiwan, this one's much more evident with the NASA nightlights. You can see that the population's heavily drawn to the west coast, reason being mountains and natural parks on the east coast. And then in Turkey, you've got a population of 79.4 million, and you can see also that the area is far greater than anything else we can see on this slide. But the key thing here is the population. So if we're looking at an earthquake pool comparison, this probably summarizes everything I've said of the last 10 minutes. You can see that PITT and the TCIP is buildings only. TRIPE also includes contents and living expenses, and the EQC building contents and any sort of upheaval of land as well. The limits are broadly similar. You can see that the smallest is 20K and the greatest is 60K. So all in, that's not such a big difference overall, I would have said. The similarities of PITT and the EQC are they're both first loss, so they'll pay from the moment there's a sort of a dollar loss almost. Whilst with the TCIP, there's a 2% deductible, and with TRIPE, there's that co-insurance pool that sits below in terms of the reinsurance structure. The premiums, PITT and TRIPE, not too dissimilar, but with the EQC, the notable thing here is that it is included if you have a home or contents policy. And then the other differential there is the TCIP, which has its varied tariff. So now moving on to the analysis. There's some caveats here. What I have done is using our own software and run all 4 countries' industry exposure database through our model using the same currency, euros. The results are aggregate losses, so I've taken the sum of all losses of 1 year, as opposed to occurrence losses, which would only ever take the maximum loss in any one given year. And just a reminder that the return periods that perhaps we're more familiar with do correspond to an actual exceedance probability. So let's have a look at a country comparison first of all. You can see that Romania and New Zealand in this country comparison, all lines of business, so residential, commercial, industrial, they're all quite similar. Turkey, as you may expect, with such a large population relative to the others, would expect larger losses as the return periods carry on. But now, if you recall, most of these earthquake pools are residential only, so it would probably be a fair representation for me only to talk about residential. But essentially, the pattern is very similar here. That one was the percentage of residential to all lines of business. So we can see here that, again, it's New Zealand, I think, at the top. I can't differentiate the colours so well, whilst Romania and Turkey are sort of middle of the road in terms of the percentage of residential losses to all lines of business. But in terms of the earthquake pool losses, you can again see that Romania, New Zealand and Turkey are exhibiting similar patterns in terms of how they operate. And it's the Taiwanese tribe that seems to be an outlier in how it would gather risks and pay out. And then, as I mentioned, in Lloyd's and other reinsurance worlds, you're going to see these 4 policies on the reinsurance market, and some of them also will exhibit potential to insure losses net of the earthquake pool. So when you pass this sort of information to a Lloyd's reinsurer, they'll be very interested to see what they would be on risk for at different return periods. And finally, and perhaps the most important one of the lot, would be the percentage of losses taken up by the pool. Here you can see that with New Zealand and the EQC, the losses start about 80% of taking all losses, and then that goes down to around about 65% as it hits the 500-year mark. The Taiwanese tribe is in effect ineffective because it's only ever taking around about 10 to 18% of the losses, whilst Romania and TCIP are exhibiting many of the similar patterns other than the dip around about the 15-year period for Romania. And that was it. Thank you.